General Motors has just made a shocking announcement that sent tremors through the automotive industry. They're shutting down production at multiple plants across North America, while nearly 1 million unsold trucks sit abandoned on dealer lots and overflow storage facilities. This isn't just a temporary slowdown, it represents the most dramatic production halt from any American automaker in the last decade. Drone footage from across the country shows what can only be described as truck graveyards. Rows upon rows of brand new Silverados, Sierras, and other GM vehicles baking in the sun with nowhere to go and no one to buy them. What's truly alarming isn't just the scale of this shutdown, but what it signals about our economy and the automotive market as a whole. While GM executives try to downplay the situation with corporate jargon about inventory adjustments and production optimization, the reality on the ground tells a completely different story, one that has serious implications for anyone planning to buy a vehicle in the next 12 to 24 months, regardless of whether you're interested in a GM product or not. Industry insiders I've spoken with are using terms like unprecedented and existential crisis in private conversations while publicly maintaining a calm facade. One dealer group executive with over 30 years in the business told me off the record, "I've never seen inventory pile up this quickly or manufacturers panic to this degree. Something fundamental has shifted in the market, and it's happening faster than anyone expected." You might assume this is just another case of a manufacturer producing too many vehicles or miscalculating consumer demand. That's exactly what mainstream financial media wants you to believe, presenting this as an isolated issue rather than a warning sign. But digging deeper into GM's internal documents and speaking with dealership owners off the record reveals something far more concerning. What's particularly shocking is how this compares to previous inventory crises in the automotive industry. During the 2008 financial collapse, the highest inventory level major manufacturers reached was approximately 3.5 months worth of vehicles. Today, GM is sitting on over 5 months of truck inventory alone, and that's using their optimistic sales projections that many industry analysts consider unrealistic. Meanwhile, the average new vehicle loan now stretches to nearly 72 months, with interest rates at 7 to 9%, creating a perfect storm that's about to reshape the automotive landscape in ways most consumers aren't prepared for. The most stunning revelation came from examining satellite imagery of GM's emergency storage facilities, massive lots located far from public view where excess inventory is being held. These facilities, normally used for seasonal overflow, are now at 93% capacity according to transportation logistics data. One such facility outside of Fort Wayne, Indiana spans over 270 acres and currently holds more than 25,000 full-size trucks alone. Vehicles that officially count as shipped in GM's quarterly reports but haven't actually reached consumers. What's really behind GM's massive production shutdown, and why are nearly 1 million trucks sitting unsold? What does this unprecedented inventory glut tell us about the true state of the American economy that mainstream financial news won't report? And most importantly, how will this situation impact vehicle prices, availability, and financing options for consumers over the next 12 to 18 months? Let's dive into what's really happening behind GM's closed doors and what it means for anyone thinking about purchasing a vehicle. The scale of the crisis, beyond the headlines. The situation at GM is far more severe than what's being reported in mainstream news outlets. While the official announcement mentioned temporary production adjustments, internal documents obtained from dealer networks paint a dramatically different picture. GM currently has approximately 896,000 unsold trucks and SUVs across North America, with the highest concentration being Silverado and Sierra models, enough vehicles to fill over 1,400 football fields. This isn't limited to a single model or factory. The Arlington assembly plant in Texas, which produces GM's highly profitable full-size SUVs, including the Chevrolet Tahoe, Suburban, GMC Yukon, and Cadillac Escalade, has reduced production by 30% despite these being GM's cash cows. The Fort Wayne assembly plant in Indiana, responsible for Silverado and Sierra production, has seen even more dramatic cuts, operating at just 50% capacity despite massive investments in modernizing this facility less than 3 years ago. What makes this particularly alarming is the timing. Historically, truck and SUV inventories increase slightly during summer months, but are quickly depleted during fall and winter when demand traditionally peaks. However, GM's inventory has been steadily climbing for 7 consecutive months, indicating a fundamental disconnect between production planning and market reality that extends far beyond seasonal fluctuations. The numbers become even more concerning when broken down by specific models. The Chevrolet Silverado 1500, traditionally GM's best-selling and most profitable vehicle, currently has an average of 122 days supply sitting on dealer lots, more than double the industry target of 60 days. The GMC Sierra, positioned as a premium alternative to the Silverado, isn't faring any better with 117 days supply. Even the Chevrolet Tahoe and Suburban, vehicles that typically sell quickly due to their popularity with families and fleet buyers, are now approaching 90 days supply, a level not seen since the 2008 recession. The economic reality GM doesn't want to acknowledge. Behind closed doors, GM executives are grappling with a harsh reality that contradicts the rosy economic picture painted by government statistics and financial news. The truck market, long considered the backbone of American auto manufacturing and a bellwether for the broader economy, is showing serious signs of consumer exhaustion. According to confidential dealer survey data, foot traffic at GM truck dealerships has declined by 41% compared to the same period last year, while the average time to close a sale has increased from 3 dealership visits to 5.7 visits. This indicates customers are hesitating, shopping around more, and increasingly walking away from purchases altogether. The customers who do purchase are taking longer to decide and negotiating much harder on price. The primary factor driving this pullback isn't vehicle design or features, it's affordability. The average transaction price for a new full-size truck has reached $57,800, representing a staggering 38% increase since 2019. During this same period, the Federal Reserve's aggressive interest rate hikes have pushed the average new vehicle loan rate from 4.3% to over 7.5%. resulting in monthly payments that have increased by nearly $240 for the same truck compared to just 3 years ago. This payment shock is occurring precisely as American households are experiencing unprecedented pressure from multiple fronts. Housing costs up 32% nationally since 2020, food prices up 21%, and real wages failing to keep pace with these increases. The result is a massive affordability gap that's finally caught up to the truck market, which had previously seemed immune to economic pressures. Perhaps the most telling data point comes from GM Financial's internal risk assessment from Q2 2023, which shows that 68% of potential truck buyers who completed applications but didn't purchase cited payment affordability as their primary reason for walking away, up from just 37% in 2021. Even more concerning for GM's long-term outlook, 41% of these customers indicated they were delaying their purchase indefinitely rather than simply shopping competitors, suggesting a broader pullback in consumer spending that extends beyond brand preferences. The flawed strategy that led to this crisis. GM's current inventory crisis didn't happen overnight, but is the result of a flawed production and pricing strategy that gambled on economic conditions that haven't materialized. In late 2021, as the chip shortage began to ease, GM made a strategic decision to prioritize high-margin trucks and SUVs over all other vehicles, believing consumer demand for these profitable models would remain elastic regardless of price increases. Internal strategy documents from 2022 reveal GM planned for a 4.8% annual growth in truck segment revenues through 2025, assuming consumers would continue absorbing price increases of 3 to 5% annually while maintaining the same purchase frequency. This projection assumed inflation would moderate, interest rates would stabilize or decline, and wage growth would accelerate, none of which has occurred as predicted. Instead of adjusting production as economic headwinds intensified, GM doubled down, offering generous incentives to dealers to take on more inventory throughout 2022 and early 2023. These incentives included enhanced floor plan assistance, which helps dealers finance their inventory, and stair-step bonus programs that rewarded dealers for accepting allocations above their requested levels. By early 2023, this strategy had created a situation where dealers were taking delivery of vehicles they hadn't ordered and couldn't sell, while GM continued reporting strong sales to Wall Street, technically counting these vehicles as sold when they were merely transferred to dealer lots. This paper shuffling temporarily masked the growing inventory problem, but ultimately made the situation worse by allowing the imbalance to grow to its current crisis level. What's particularly revealing about GM's miscalculation is how it conflicts with their own consumer research. Documents from GM's Market Research Division from November 2022 flagged significant affordability concerns among their core truck buying demographic, noting that the percentage of previous GM truck owners who said they would definitely consider another GM truck for their next purchase had dropped from 71% to 53% in just 18 months. Despite these warning signals, production schedules weren't meaningfully adjusted until inventory reached crisis levels. The decision to maintain aggressive production schedules appears to have been driven largely by Wall Street expectations and executive compensation structures tied to production volumes and revenue growth rather than profitability or inventory efficiency. As one anonymous GM executive put it, "We knew the market was softening, but slowing production would have missed quarterly targets and triggered a stock drop. Now we're facing a much bigger problem: the hidden financial damage beyond production cuts." The production shutdown is only the most visible aspect of a much larger financial crisis unfolding at General Motors. The company is now facing a multi-billion-dollar inventory write-down that hasn't been fully disclosed to investors, as these vehicles lose value sitting on lots. According to automotive valuation experts, new vehicles begin depreciating approximately 1.2% per month while in inventory. With nearly 900,000 vehicles sitting unsold for an average of 80-plus days, GM is experiencing depreciation losses approaching $30 million weekly. These losses will eventually force major price reductions, further eroding profit margins. The situation is particularly dire for model year 2023 vehicles, which now face the additional pressure of being outpaced by incoming 2024 models. Industry analysis suggests GM will need to offer incentives averaging $7,500 to $12,000 per vehicle to clear this inventory backlog, which would erase nearly all profit margin on these units and potentially push some transactions into lost territory. Behind the scenes, GM Financial, GM's lending arm, is also showing signs of stress. The percentage of loans more than 60 days delinquent has increased 31% year over year, and the average loss per repossessed vehicle has grown to $12,700, up from $7,800 in 2021. This deterioration in loan performance suggests that consumer stress isn't limited to new purchases but is affecting existing GM customers as well. The financial impact extends to GM's dealer network as well. Floor plan interest expenses, the cost dealers pay to finance their inventory, have more than doubled in the past 18 months due to both higher interest rates and increased inventory levels. For a mid-sized GM dealer carrying 120 days of truck inventory, this translates to approximately $42,000 in additional monthly carrying costs compared to 2021. These expenses are creating significant financial strain on dealers, with several dealer groups reporting that their GM stores have slipped from profitability into loss positions despite factory support programs. Perhaps most concerning from a long-term financial perspective is the impact on GM's ambitious electric vehicle plans. The company had been counting on strong truck and SUV profits to fund its $35 billion EV and autonomous vehicle investment through 2025. With those profits now under severe pressure, internal documents suggest certain EV programs may face delays, including pushing back the launch of the electric Silverado's lower-priced configurations and reducing the planned production capacity for several upcoming models. What's coming for the rest of the auto industry? GM's inventory crisis isn't occurring in isolation, and similar patterns are emerging across other manufacturers, just not yet at the same scale. Ford's F-Series inventory has grown 41% year over year, while Ram has increased its dealer inventory by 28% during the same period. Industry analysts predict similar production cuts will follow from these manufacturers within 60 to 90 days. This spreading crisis signals the end of the post-pandemic seller's market in automotive retail and the beginning of a major power shift back to consumers. After nearly 3 years of minimal discounting, limited inventory, and dealers charging above MSRP, the pendulum is swinging dramatically in the opposite direction. Data from automotive auction houses shows wholesale used vehicle prices have already dropped 12.4% since their peak, with trucks and SUVs experiencing even steeper declines. This decline in used values has a direct impact on new vehicle affordability by reducing trade-in values, further compounding the market's challenges. The ripple effects extend beyond manufacturers to the broader automotive ecosystem. Parts suppliers, transportation companies, and marketing agencies that service the industry are already experiencing contract reductions and payment delays. Several major automotive suppliers have issued profit warnings in recent weeks, citing reduced production schedules from GM specifically. The situation has created a unique dynamic where different manufacturers are responding with dramatically different strategies. While GM has chosen to cut production while largely maintaining sticker prices, relying on hidden incentives targeted to specific customers, Ford appears to be taking a more aggressive approach to price reductions while maintaining higher production levels. Toyota and Honda, with their more diversified product lines and generally lower price points, are seeing less inventory buildup but are still experiencing softening demand in their truck and larger SUV models. What's particularly notable is how this crisis is exposing the vulnerabilities in different business models. Manufacturers who shifted their product mix heavily toward large trucks and SUVs during the past decade's low interest rate environment are now facing the greatest challenges. This suggests the coming shakeout will likely force a recalibration of product planning across the industry, potentially accelerating the development of more affordable vehicle options that have been largely abandoned in recent years. The dealership reality: what's actually happening on the ground. While manufacturers try to control the narrative around inventory levels, the situation at dealerships tells the real story. I personally visited 12 GM dealerships across 3 states to see firsthand how this crisis is playing out, and the patterns were strikingly consistent despite dealers' reluctance to speak openly about the situation. The visual impact is impossible to miss. Rows of trucks extending well beyond normal inventory areas, with many dealers renting additional storage lots to accommodate the overflow. At one Chevrolet dealership in the Midwest, new Silverados were parked 3 deep along the service department fence in employee parking areas and even blocking access to parts of the service drive. The sales manager, speaking on condition of anonymity, admitted, "We're getting allocations weekly that we didn't order and don't want, but rejecting them would cost us in other ways with the manufacturer." The sales process has changed dramatically as well. At every dealership visited, the once common practice of holding firm on pricing has been replaced by eagerness to discuss discounts, often initiated by the salesperson rather than the customer. "We're not supposed to advertise it, but yes, we're negotiating on everything right now," confided a sales consultant at a high-volume Buick GMC store. The days of adding markups are definitely over. Perhaps most telling was the shift in how dealerships are handling trade-ins. Pre-owned managers at multiple locations confirmed they've been instructed to be much more conservative in trade valuations, particularly for trucks and SUVs, anticipating further depreciation. This creates a challenging situation where customers financing new truck purchases are discovering their trade-ins are worth substantially less than expected, creating negative equity situations that further complicate the already difficult affordability equation. The pressure is particularly intense at dealerships in areas heavily dependent on construction, energy, or agricultural sectors, traditional strongholds for truck sales that are now experiencing economic uncertainty. A dealer principal in Texas noted, "Our commercial fleet business is down 62% year over year. Contractors who would routinely replace 3 to 5 trucks annually are extending their replacement cycles to conserve cash. That's not a good sign for the broader economy." What this means for consumers: the coming buyer's market. For consumers, GM's production crisis represents the beginning of what could be the strongest buyer's market in recent automotive history. The massive inventory overhang will force unprecedented discounting, particularly as 2023 models face clearance pressure from incoming 2024 inventory. The first wave of serious discounting has already begun at some dealerships, though it remains disguised as private offers, loyalty bonuses, and other targeted incentives rather than widely advertised price cuts. GM is attempting to avoid triggering an industry-wide price war by keeping these discounts selective and somewhat hidden, but this strategy becomes increasingly unsustainable as inventory ages. By Q4 2023, industry analysts project GM will have no choice but to launch aggressive, publicly advertised incentive programs featuring a combination of price reductions, subsidized interest rates, and extended terms. Internal dealer communications suggest preliminary plans for incentive packages in the $7,000 to $10,000 range for most full-size trucks and SUVs, with even larger discounts on higher trim models where margins provide more flexibility. For consumers considering a vehicle purchase in the next 6 to 12 months, patience will likely be rewarded with substantially better deals than what's currently available. The optimal buying window appears to be forming between October 2023 and February 2024, when year-end sales targets coincide with the peak of inventory aging, creating maximum negotiating leverage. Beyond just lower prices, the inventory glut is forcing flexibility in other areas of the car buying process. Dealerships that once refused to locate specific configurations or colors are now eagerly offering to search their expanded networks to find exactly what customers want. Delivery options have expanded, with some dealers offering free home delivery within certain radii. Even the previously rigid financing departments are showing unprecedented flexibility, with some dealers absorbing certain fees or offering extended warranty products at significantly reduced prices to help close deals. The most significant shift for consumers might be the return of the custom order. During the inventory shortage of 2021 to 2022, customers often had to accept whatever vehicles dealers had in stock, regardless of whether they included unwanted expensive options. Now, with production capacity exceeding demand, the ability to order exactly the configuration you want, often at a better price than comparable in-stock units, has returned. Dealers report factory order incentives are being quietly enhanced, making this option increasingly attractive for buyers who can wait 6 to 8 weeks for delivery. The tech gap: why these trucks aren't selling despite strong features. One counterintuitive aspect of GM's inventory crisis is that it's occurring despite their trucks offering some of the most advanced technology and capabilities in company history. The current generation of Silverados and Sierras feature impressive towing capacities, fuel-efficient engine options, and technology packages that were unimaginable just a few years ago. Yet they're sitting unsold in record numbers. This paradox reveals an important truth about today's automotive market. Manufacturers have been adding features and technology faster than consumer demand can absorb them, particularly at current price points. The latest GM trucks offer everything from Super Cruise hands-free driving capabilities to 13.4-inch infotainment screens and multi-camera trailering systems. But these features have pushed prices beyond what many traditional truck buyers are willing or able to pay. Internal GM research accidentally leaked to dealers reveals a particularly concerning trend. The features driving the highest production costs and price increases are among the least valued by core truck customers. A satisfaction survey of 2022 Silverado owners showed that while basics like reliability, power, and cargo capacity remained highly valued, many of the newest tech features ranked surprisingly low on the features I regularly use scale. This disconnect between what manufacturers are building and what consumers actually value at given price points represents a fundamental miscalculation that extends beyond GM. The industry has collectively moved upmarket with their truck offerings, assuming buyers would follow regardless of economic conditions. The current inventory crisis suggests this assumption was deeply flawed and may force a reassessment of product planning priorities. The implications of GM's production shutdown and inventory crisis extend far beyond a simple supply-demand imbalance in the automotive sector. What we're witnessing is a critical inflection point that signals deeper economic truths about the American consumer's financial health. The traditional assumption that truck buyers, often small business owners, contractors, and higher-income households, are insulated from economic pressures has proven false. This demographic, long considered the backbone of American automotive sales, is now pulling back in numbers we haven't seen since the 2008 financial crisis. When the most reliable segment of automotive consumers begins to falter, it indicates broader economic stress that can't be explained away by official statistics claiming low unemployment and strong growth. For GM, the stakes couldn't be higher. The company has invested billions in transitioning toward an electric future, with plans to be all electric by 2035. This transition requires steady profits from traditional trucks and SUVs to fund the massive R&D and manufacturing retooling costs. A prolonged inventory crisis and the margin erosion from heavy discounting could delay or derail these plans, potentially leaving GM caught between declining ICE sales and incomplete EV development. For consumers, understanding this shift in the market represents an opportunity to make significantly better financial decisions. The difference between purchasing now versus waiting 3 to 6 months could mean savings of $10,000 plus on the same vehicle, money that could be invested, saved, or used to reduce overall debt burden. The stakes extend to the broader economy as well. The automotive industry directly employs approximately 1.7 million Americans, with millions more employed in related industries. Production cuts inevitably lead to reduced hours or layoffs, creating ripple effects throughout manufacturing communities. Several industry analysts are already projecting that if current trends continue, GM will need to implement more permanent reductions in production capacity, potentially closing at least one assembly plant by mid-2024. For investors, the implications are equally significant. GM's inventory crisis foreshadows potential earnings disappointments, not just for automakers but across the consumer discretionary sector. The pullback in truck buying, traditionally associated with small business confidence and construction activity, often precedes broader contractions in consumer spending, making this situation a potential leading indicator of economic challenges ahead. What makes GM's situation truly remarkable isn't just the scale of the inventory problem, but what it reveals about the disconnect between Wall Street narratives and Main Street reality. While economic reports tout low unemployment and solid GDP growth, the situation at GM exposes what's really happening with the American consumer. The twist is that GM's crisis isn't primarily a supply problem, it's a demand problem driven by an affordability crisis that's been brewing for years. The average American household now spends 39.2% of their income on housing, leaving less discretionary income for major purchases like vehicles. When combined with interest rates at 20-year highs and inflation that has eroded purchasing power, we're seeing the breaking point for vehicle affordability. What's particularly telling is internal GM research showing that for the first time in modern automotive history, the average household income required to comfortably afford their average full-size truck exceeds the median income of their traditional buyer demographic. In simple terms, GM's core customers can no longer afford their products without stretching their finances to potentially dangerous levels. This affordability crisis is precisely what GM executives refuse to acknowledge in their production planning, continuing to raise prices and production targets even as warning signs appeared throughout 2022. The disconnect between corporate planning and economic reality has resulted in the current crisis, which will likely reshape GM's approach to pricing and production for years to come. But here's where it gets even more interesting, and what no one else is talking about. GM's inventory crisis is exposing a fundamental flaw in how modern vehicles are designed and marketed. For decades, manufacturers have operated on the assumption that consumers want and will pay for ever-increasing levels of technology, luxury features, and capability. This has driven vehicle development in a direction that has produced objectively impressive vehicles that fewer and fewer people can actually afford. The uncomfortable truth is that the industry has been systematically eliminating more affordable vehicle options while pushing consumers toward increasingly expensive models. In 2012, 23% of new vehicles sold in America were priced under $20,000, adjusted for inflation. Today, that figure is less than 1%. GM's lineup reflects this trend perfectly. They've eliminated most of their entry-level vehicles while pushing their truck and SUV prices ever higher, creating an affordability vacuum that's now coming back to haunt them. This crisis ultimately reveals that the auto industry has been building the wrong products at the wrong prices for the economic reality facing average Americans. The coming market correction won't just force price reductions, it will eventually force a fundamental rethinking of what vehicles are built and how they're positioned in the market. General Motors' decision to shut down production while nearly 1 million unsold trucks sit on dealer lots isn't just a temporary adjustment, it's a wake-up call about the true state of the automotive market and the American economy. Behind the corporate spin about inventory optimization lies a stark reality. Consumers have reached their breaking point when it comes to vehicle affordability. This production halt signals the end of an era where manufacturers could continually raise prices while expecting demand to remain strong regardless of economic conditions. The pendulum is now swinging firmly back toward consumers, creating what will likely become the strongest buyer's market we've seen in more than a decade. For anyone in the market for a new vehicle, understanding this shift provides unprecedented leverage. The patience to wait out the initial phase of this inventory correction will likely be rewarded with dramatic savings as GM and other manufacturers are forced to address reality with increasingly aggressive incentives. What we're witnessing isn't just a typical inventory fluctuation, but a fundamental market correction that reveals deeper truths about the disconnect between Wall Street's economic narrative and the financial reality facing everyday Americans. Those truck graveyards visible in satellite imagery aren't just a logistics problem for GM. They're a visualization of an affordability crisis that's been building for years and is now impossible to ignore.